What was the news to you in today's announcement?
Well, the news was that it was completely predictable, and the market went back to sleep as soon as it saw it, which is probably as it should have been. This was Chair Yellen's literally swan song, last meeting. I imagine that in the room there was a certain amount of nostalgia and so forth, that sweet glow that is attached to such an event. But from a policy perspective, their course is set. And they told us that, they've told us that repeatedly, but they told us that, they reiterated it today with the use of the word further. Right? Further action. Okay, that means coming soon and in a direction that we know. The funds rate is going to go up some more because they think it's an appropriate thing to be doing.
And expectations of future inflation, because it feels like, again, it comes down to this. And there did seem to be acknowledgement there about what we're seeing in the markets, which is that inflation break-evens are tracking higher, it seems. There's still hope there that normalization of what we would expect from inflation at this point, given everything else that's going on, will eventually appear.
Well, this is a little bit a reflection of Chair Yellen's legacy. She is, after all, a labor economist before she's a central banker, and the Phillips curve is an established doctrine in that field. So as the unemployment rate has come down, she, as the leadership of the Fed, but the Fed more broadly, has taken the view that sooner or later this will manifest itself in wage and price pressures. The fact that it hasn't in any important way so far is sort of the difference between, what shall I say, science and religion.
Details.
Yeah.
Minor.
But, they think it will in due course. And the market's issue, when all is said and done, is that if this had all started with the Fed funds rate, let's say, at 3%, then, of course, they wouldn't be doing anything.
Yeah, different story.
They started near zero. So until they get to some zone that is comfortable for them, their course is set, and they've been reiterating that, and they did again today.
Yeah. Well, Janet Yellen really broke the mold when she wondered aloud, pondered about the mystery of inflation, why it hasn't gone up. I wonder, as Jay Powell succeeds her, whether he's going to try to break the mold in what she's established as kind of the running of the Fed. How's he going to put his mark on the Federal Reserve? Is it going to be in the way he communicates with the public through the statement? What are you looking for?
Well, Tom Keene, of course, told us his first assignment is to learn to use a Bloomberg terminal. So I'll reiterate that. I'll accept that. But I think...
He already knows.
Yeah, no, that's probably right. I think his basic responsibility now, that to the degree it's at all different, is to restore the standing of the Federal Reserve within the Washington community. We live in a time when, for better or worse, there's a certain... suspicion, if you will, of the permanent government, of the agencies, of the bureaucrats and so forth. The Federal Reserve is not immune to that.
How does he do that?
By being himself, I suspect. He is, after all, an old Washington hand. He's a very sober fellow in his demeanor and so forth. And I think that will go a long way.
Let's talk about markets. What do you see when you look at the yield curve? Or short-term rates or whatever.
Yep.
What do you see them anticipating, and how does that differ from, say, what you would expect or what you think the Fed is going to do?
Well, I think the market is getting approximately to this three dots sort of idea, and that seems sensible enough. I think one of the traditional patterns is, as the Fed begins a tightening cycle, yield curves tend to flatten, credit spreads and spreads of all sorts tend to tighten, and the stock market tends to go up. Because historically, the Fed starts this tightening phase fairly near the trough of a recession. The economy is starting to get better. So profits are recovering off recession lows. Defaults are coming down from recession highs. That's not where we are. Defaults are, in some sense, at zero. The profit share is very, very high, getting a big boost now, of course, from the tax changes. And so the question is, will that be different? Well, so far, no. So far, the yield curve's been flattening, credit spreads have been coming in, and the stock market's been going up. Question is, will that persist? And I have, what shall I say, mixed feelings on that score. It's not an easy judgment. This time it's different is supposed to be a very dangerous turn of phrase. On the other hand, sometimes it really is different.
You're allowed to say it if it's actually different. You're supposed to not say it if you're just being sane.
Precisely, and that's my point. I mean, this is a difference. The Fed's commencing this cycle of tightening at a very different phase of the business expansion. The other feature that's probably worth giving some additional thought to is that a deficit country that needs capital support from the rest of the world tends to find that if its currency is weakening, its yield curve tends to steepen. And that's another wrinkle in this particular moment that's a little bit unusual compared to past patterns with respect to the early phases of Fed tightening cycles.
And even when we have days of risk off, the dollar just simply can't catch a break. So there's a real strange sentiment about what's going on, I think, with the US dollar, particularly at this moment. What are clients saying to you? Because we have so many, a confluence of factors here, whether it's greater refinancing as a result of the tax overhaul, what that does to the back end. We've got, as you say, a historic moment in terms of monetary policy and the retraction of that, but global issues going on too that will impact the US rate curve as well. What are clients saying?
Well, I think it's fair to say that because of the behavior, particularly of central banks, taking risky assets onto their balance sheets, reducing the quantum of volatility that we as private investors have to absorb and deal with and so forth, one of the effects of that, if you do it for long enough, is that in that environment, you have to be short volatility in some form in order to perform, in order to make money. And so in some loose sense, if you observe somebody in the market today, they've survived the last 5 to 10 years, which means they have a short volatility strategy in place. Sometimes that's explicit. We call them volatility harvesters, people who literally sell volatility. Others have it in an implicit form. Some are more self-aware in this regard than others. But that's the critical issue. How do you unwind that in an orderly way? And that's not an easy question to answer because, like any other big environmental change, it really is the case that everybody is in the same spot,
the wrong way around.
And climate is changing, so to speak.
Do you see people starting to unwind that right now?
I think there's a lot of thought process about how to do that efficiently, more so than actual behavior in that direction. But you notice volatility's been inching up in all of these markets, and I think that's attracted the attention of investors, as well it should.